Hi there, welcome to kneppyinvests. There are many investing strategies out there, and one strategy I don't use much at all, I have used it on occasion, particularly in commodity companies, is looking for those companies whose share price is at a multi-year low. I'm not sure why this would be a successful investing strategy, because more than likely there are reasons why the company's share price is at these historic lows. What I'm going to do in this video is look at 10 ASX stocks that are at multi-year lows, and then to try to figure out if these companies are a potential buy or an absolute avoid. So let's get stuck into it. And the first company we'll be looking at is a company I just featured recently in one of my videos, and what is sort of the inspiration for me doing this particular video, and that is Platinum Asset Management. With most of these charts, we'll be looking at weekly or monthly charts going back a fair way into the company's life. And for Platinum Asset Management, that's going back to 2007. We can see that Platinum Asset Management has not been a good investment for the long term over this time period. And we can see some wild fluctuations in the share price. During the GFC, the share price got down to about $2.80, and highs we have seen the share price get to as high as almost $10, but not quite. During 2014, we saw share price get to about $8.50 during 2018, or start of that year. But right now, the share price is at the lows we saw during the GFC and also during the COVID-19 financial panic. Platinum Asset Management share price got down to about $2.60 for a very brief period of time. So when I did that video, which did feature Platinum Asset Management, I did see that this company's share price was at historic lows. So I thought, would that mean this is a good time to take a position in this company? Because the other thing I noticed with Platinum Asset Management, when you look at some of the valuation metrics, they were looking fairly low. So I went to their AGM or something, whatever it was, just to see what the commentary was and the management feeling about this company was. And when I did read something in their commentary, it did give me pause. So I'll just give you some quotes from their AGM. Given the relative underperformance, 2%, some investors may be questioning the benefits of investing with an active manager like Platinum. And then they went on to explain their investing philosophy. They are focused on seeking out of favor and overlooked parts of the market through its contrarian index agnostic approach. They mentioned one of the reasons why there's been a significant sell down in share price over the past 5 months. There's a big sell down by a large shareholder. And sometimes when that does happen, that does give us opportunities to buy into a company at cheaper prices. So I thought maybe this was a good sign for Platinum Asset Management until there was a question about why they're not doing any share buybacks. And the answer to that from management was, given our recent investment performance and client redemptions, we do not appear to be undervalued right now. So straight away, that was me thinking that management doesn't think this company is undervalued, so I shouldn't think that this company is good value right now, and there's no way I'll take a position in Platinum Asset Management, even though we are at historic lows right now. So this is a definite avoid right now for me. A company I have been interested in and am following even to this day really closely is Integrated Research. And this is the weekly chart going back to 2015. And there have been periods of time during the past 6 years where the share price of Integrated Research does come under pressure. We saw it during 2018 and 2019, when the share price fell from $4 all the way down to $1.50, but then recovered really well. In fact, then the share price went on a run from $1.50 to $4.90. But since that high, which was reached towards about September of last year, the share price has just kept on falling. In fact, it's fallen from $4.90 to a current share price of $1.32. Not only that, the share price has fallen past the previous low we saw towards the end of 2018 at around $1.50. And I was thinking of taking a position in this company around $2. But I just decided to hold back because the share price was in a well-defined downtrend on the weekly chart. I thought I just want to see some signs of the share price turning around. And one of the reasons I was thinking of taking a position is because it does look like the company is turning things around based off their most recent financial reports. But I just want to see that the market is more interested in this company. But the share price has just kept on falling. And that support level of $1.50, the share price has just fell through that without any resistance. And that is not a good sign for integrated research. So right now, at a share price of $1.32, that is a 6-year low for this company's share price. So I'm still interested in integrated research. I do think they have the ability to turn things around, but I just need some signs. And I think the best sign we can get from this company is financial or good financial news. And that might be a market update or something like that. So I'm looking every day for that sort of announcement from this company. Next company I want to look at is Ryzen. And I still remember when this company IPO'd about 10 years ago. This company transports coals in trains and stuff like that. I don't really follow this company or too closely because it's definitely not the sort of company you want to hold for the long term in your portfolio, as you can see by this weekly chart going back to 2012. But the most interesting thing about Aurizon right now, it's at a real solid support level at $3.40. And the reason I'm calling that real solid support level is because it has reached that share price twice in the past 5 years or 6 years. Once at the start of 2016, and then again during the COVID-19 financial panic, and then bounced off it both times. So will we see the same thing in the next few months with the company's share price? And we have seen a dramatic downward trend in the share price over the past year. In fact, the share price has fallen from $6.10 to $3.40 during that period, which does surprise me because coal prices have increased. I thought that would translate to Aurizon, but it really hasn't. And over the past 5 weeks, we have seen the share price fall quite considerably, particularly 4 and 5 weeks ago when the share price fell in consecutive weeks from about $4 all the way down to $3.40. But in saying that, the last 3 weeks, the share price has just moved sideways right on that $3.40 support level. I have no interest in holding this company for the long term, but this could be a good short-term trade because if you buy in about $3.40, you will sell out if the share price moves below towards $3.30, $3.20, because that would mean that support level has broken. So a potential low-risk short-term play here with Aurizon right now. There are many reasons why a company can be at multi-year lows. For instance, just sentiment can drive a share price down, some short-term bad news, but sometimes it can just be structural problems for the business itself. And I think that's what's been happening to AGL over the past, we'll say, 2 or 3 years. Share price of AGL was in a nice long-term uptrend from the start of this period. So this is the monthly chart. So the start of this period is 1996. And we did see the share price of this company go from $5 to a high of $28 from 1996 to that high in 2017. But since that high in 2017 at $28, we have seen the share price fall quite considerably, particularly over the past 2 years. In fact, the share price has just fallen off a cliff. And we have started to see volume increase. And that's the only thing that has kept me interested in this company, is just that increase in volume. But every single month, the share price decreases. And right now, we are at a 25-year low for AGL. I want some signs that this downtrend in the share price is coming to a stop, because there is potential that this could be a permanent problem for this company. There is talk of them spinning out their green division, their renewable energy division, that sort of thing. And maybe that's a solution to fixing the problems this company has been facing. But unless we see signs that these problems have been fixed, there's no reason to take a position in this company just yet, because the share price could keep on falling. And it seems like this is a classic case of don't catch a falling knife. Next company I'll be featuring in this video is a company I have been following very closely for about 5 or 6 years, but I've never taken a position in. And this is a company I've been just patiently waiting for that opportunity. And the reason I'm waiting for that opportunity is I do think there is some massive tailwinds behind this company because of what they do. So this Fluence is all about water and wastewater management, which is going to become a massive thing in the future. And right now, share price of 18 cents is really appealing for numerous reasons. But let's go back to 2015 or 16 when I started following this company, and there was a lot of hype influence around that time period. In fact, share price rose from 20 cents to $1.20. Sometimes the market, sometimes investors can be a little bit too early to the party. I think that's what happened with Fluence back then. And then that hype waned away, died away, and that's why the share price has been gradually falling over the past 5 years from that high of $1.44 to a current share price of 18 cents. But 18 cents does seem to be a fairly solid support level for Fluence because we have seen the share price reach 18 cents about 3 or 4 times in the past 15 months. And every time the share price reaches 18 cents, we do see a bounce, but the bounces have become lower and lower or less powerful with each time we do see that bounce. It does look like a descending triangle here. And when you do see a descending triangle, so you have that horizontal support level, and then you have a descending sort of a resistance level. And then what you have to wait for with these descending triangles or ascending triangles is a breakout to the upside or a breakout to the downside. And that's what I'm waiting for right now. But you could take a position at 18 cents, a low risk position, particularly if you do like the future of this company. I do think there definitely is potential for Fluence. So I wouldn't necessarily not take a position at 18 cents. But I think the better play would just be waiting for the breakout to the upside before you take a position, because there could be a breakout to the downside with this descending triangle. Next company I want to talk about is XTek, and I actually do have a small position in this company. I've had a small position in this company for about, I think, 8 years now, and I've just maintained a holding, very small holding, and I've seen wild fluctuations in the share price since then. But over the past year, the share price has taken a massive dive from about 90 cents to a current share price of 25 cents. And that 25 cents is an 8-year low. And we have seen some issues with the company during the past year. In particular, they have been affected by COVID-19 and then also some bad management decisions. And one of those bad management decisions was doing a capital raising when the share price is at 8-year low. You prefer management to do capital raisings when the share price is at an all-time high, not at an 8-year low. But they've decided they need to do that capital raising. I partook in that capital raising. And if the share price falls much lower from here, I also take or add to my position as well in this company, because I think this negative sentiment can't get any lower. This company won't go broke. They do $30 to $40 million of revenue. I think that will grow over the next few years. They're into armor, that sort of thing, hence protect and sustain. So keeping a close eye on the movement of XTek. I just think this negative sentiment has just driven the share price way lower than it should be, and that sometimes can be a good time to take or add to your position in a company. Now onto a gold producing company that have operations in Africa, and that's Resolute Mining. Even though I do know what they do and where their operations are, I don't know a lot about Resolute Mining itself, but it does seem like there are some issues this company is facing just based off the share price action over the past few years. I'll just compare Resolute Mining's chart to Perseus Mining. Perseus Mining share price just keeps on going up, and Resolute Mining share price just keeps on going down. But in saying that, and with acknowledging that I don't know much about the company, share price at 42.5 cents could be a good level to take a position in this company if you're confident about the future of Resolute, because 42.5 cents seems like a fairly solid support level. We've seen share price reach 42.5 cents in March this year and then bounce off it. And over the past about 5 or 6 weeks, share price has just been remaining around this level at 42.5 cents. So it does look like a potential low risk play if you do like the future of this company. Personally, the only time I will look at multi-year lows and take a position in companies are commodity driven companies when the commodity itself is at multi-year lows, because that's telling me that it's at the bottom of the cycle. And that's the best time to buy mining companies, when the underlying commodity they're mining is at bottom or multi-year lows, or the bottom of the cycle. Gold is not right there yet. Who knows what's going to happen in the next few years, but I do like having that strategy. When you compare to a lot of people buying Fortescue, BHP, Rio, when iron ore prices were at all-time highs or near all-time highs, I like to do the complete opposite. So I'll be waiting to see if iron ore prices can fall to like $50 a ton, something like that, and that's when I might take a position. McPhersons or McPhersons is a company on the ASX I don't know much about. They either sell and manufacture health or beauty products, and to be fair, I've had no interest in this company in the past, and that could have been a mistake back in July, August of 2019, because there was a bit of a breakout in the share price from about $1.30. Share price kept on rising all the way to a high of about $3.35, which was reached in September of 2020. But this company went through some problems in October, November of 2020, because the share price fell from about $3 all the way down to a low of $1.12. So the share price decreased 67% in a 2-month period. So there must have been some significant bad news for the company. In fact, the share price fell at a greater rate, maybe not a greater rate, but more during that period, 2-month period, than it did during the COVID-19 financial panic. And the share price has kept on falling since then. So this is telling me a lot of negative sentiment around this company right now, but we have seen an increase in volume over the past few weeks at the share price of about 89 cents. So it does seem like 89 cents could be a good support level, because the last time we've seen it, our share price this low was way back in 2017, and then share price bounced off it. And then if we go further back, the last time we've seen a share price this low was way back in 2016. So this is right at a 5 to 6 year low. It's just that increase in volume that's got me a little bit interested in McPhersons. This could be an exhaustion of sellers, or it could be just some technical analysis or traders seeing that it's at a 4-year low, nice support level, and they become interested with a short-term trade in this company. I might want to do a little bit more research on McPhersons just to see what they do. But at this point in time, I really don't have the motivation to do that, because so much negative sentiment with this company right now. I did not expect to see an iron ore producer on this chart of companies with or at multi-year lows, but Mount Gibson Iron is at that point right now, with the share price at 37.5 cents. Last time we've seen it this low was way back in March or April of 2018. You can just see the effect of higher iron ore prices on Mount Gibson Iron back in 2019. The share price rallied all the way to a high of about $1.30. You also see how the decrease in iron ore has affected Mount Gibson over the past 3 or 4 months, with the share price falling from about $1 all the way to the current share price of 37.5 cents. So I think Mount Gibson Iron might be, maybe the costs of getting the iron ore out of the ground is a little bit higher than Fortescue, Rio, and BHP, and that's why the share price has suffered way more than those other companies. But I don't know a lot about Mount Gibson Iron, so if you do know a little bit more, please tell us why you think Mount Gibson Iron share price has fallen significantly more than those other iron ore players. Speaking of descending triangles, I'm pretty sure I've mentioned a company with a descending triangle in this video. Avita Medical definitely has a descending triangle over the past 15 months. This is a company I really like what they do, but the valuation of Avita is about 500 million. So they really have to prove to me that they can become operational cash flow positive and profitable to justify where they are right now in terms of valuation. So I want this company to succeed, even though I'm not a shareholder, simply because of what they're doing. They're all about burned treatments. And the problem I see with Avita Medical right now is we did see a nice developed descending triangle over the past 15 months. And that descending triangle looks like it has been broken to the downside in the last week. And that's actually a bad sign that the support level at around about $4.40 has broken and the share price could fall quite a bit from here. So right now, the share price for Avita is at a 2.5-year low. Last time we saw it this low was way back at the start of 2019. The share price was actually breaking out and starting to go on a run, a fairly significant run at that. In fact, the share price increased from $1.50 all the way up to a high of $17 in about 1 year of trading. But it's usually when you see that sort of hype, the company in the end needs to justify that valuation, because the valuation of Avita back then would have been probably over $1 billion. And for a company that's not profitable, growing at a nice rate, but burning through a lot of cash, at some point in time, it needs to prove to us that it can become cash flow positive and profitable. That's all I have for this video on companies that are at a multi-year low. Question is whether they're buys or avoids. For most of these companies, I'd say they're either a void or just a hold, and keep a watch on how they will perform over the next few months. In fact, I've just decided right now I'll do a follow-up video on these 10 companies in the future, maybe a few months down the road, 6 months down the road, just to see how they have performed from these multi-year lows. I do expect some of these companies' share price will be lower from where they are now. Some might be higher. If you have any questions about these companies or any other companies on the ASX, please leave a question, comment, your feelings in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.